Warren Buffett, widely regarded as one of the greatest investors in history, boasts a staggering net worth of $80 billion. In my channel, I often emphasize learning from Buffett's experiences and those of his partner, Charlie Munger. Their remarkable success is rooted in investing in companies with sustainable competitive advantages and holding on to them for the long term. While Buffett's company, Berkshire Hathaway, chooses not to pay dividends, a substantial portion of their holdings does. In fact, the investments overseen by Buffett generate over $4 billion annually in dividend income. In this video, I will delve into how Buffett's substantial cash flow allows him to consistently double his money on many stocks. Buffett's long-term investing strategy revolves around being a value investor. This approach entails selecting stocks that trade for less than their intrinsic or book value. However, his strategy has evolved over time, influenced significantly by Charlie Munger. The shift towards prioritizing the quality of the underlying business was a valuable lesson learned through their investment in See's Candy.
I've been taught by Ben Graham to buy things on a quantitative basis. Look around for things that are cheap. And that I was taught that, say, in 1949 or 50. It made a big impression on me. So I went around looking for what I call used cigar butts of stocks. And the cigar butt approach to buying stocks is that you walk down the street and you're looking around for cigar butts, and you find this on the street, this terrible looking, soggy, ugly looking cigar, one puff left in it. But you pick it up and you get your one puff. Disgusting, you throw it away, but it's free. I mean, it's cheap. And then you look around for another soggy, one puff cigarette. Well, that's what I did for years. It's a mistake. Although you can make money doing it, but you can't make it with big money. It's so much easier just to buy wonderful businesses. So now I would rather buy a wonderful business at a fair price than a fair business at a wonderful price. You really want to be in a wonderful business because the time is the friend of the wonderful business. You keep compounding, it keeps doing more business, and you keep making more money.
Now I'll tell you exactly why walking away from See's Candy would have been a terrible idea.
But we both kept learning all the time, so that the man we were 5 years earlier was less sensible than the man who ultimately was there. And See's Candy did teach us both a wonderful lesson, and it'll teach you a lesson if I tell you the full story. If See's Candy had asked $100,000 more, Warren and I would have walked. That's how dumb we were at that time.
10,000 more.
And one of the reasons we didn't walk is while we were making this wonderful decision, we weren't going to pay a dime more. Ira Marshall said to us, "You guys are crazy. There's some things you should pay up for. You're underestimating quality." Well, Warren and I, instead of behaving the way they do in a lot of places, we listened to the criticism. We changed our mind. And that is a very good lesson for anyone. The ability to take criticism constructively is well, think of all the money we made from accepting that one criticism. And if you count the indirect effects from what we learned from buying See's, you can say that Berkshire's been built partly by learning from criticism.
In 1972, Warren Buffett and his partner Charlie Munger made a strategic move by acquiring the entire See's Candy Company for $25 million. During that year, the company reported $31 million in sales, generating $2.083 million in profits after taxes, and required a working capital of $8 million to operate. Despite the initial reluctance to pay more than the offered $25 million, this decision proved to be far from idiotic. Fast forward to 2007, and See's Candy had contributed significantly to Berkshire Hathaway, earning pre-tax earnings of $135 billion. The company's sales had soared to $383 million, resulting in over $82 million in pre-tax profit. Buffett's investment in See's Candy was yielding remarkable returns, well over tripling the initial investment each year. The price paid in 1972 became irrelevant, emphasizing Buffett's focus on the business's long-term potential and cash flow. As of 2019, Buffett stated that See's Candy had generated well north of $2 billion in pre-tax earnings, continuing to be a cash cow for Berkshire Hathaway. See's Candy perfectly encapsulates what Buffett seeks in a business, a competitive advantage built on a strong brand and customer loyalty. For Buffett, long-term competitive advantage in a stable industry is a key criterion in business selection. Even without rapid organic growth, a business that provides reliable earnings can be rewarding, and these earnings can be used to acquire similar businesses elsewhere. Buffett's investment strategy does not specifically target dividend stocks. However, many of his holdings pay dividends. This correlation arises from the types of businesses he targets, often mature, highly profitable companies with proven business models. Berkshire Hathaway, led by Buffett, earns around $4 billion in annual dividends, reflecting the success of his investment approach and the enduring profitability of the businesses he has chosen to invest in over the years. Warren Buffett's impressive dividend income is not limited to returns from companies where Berkshire Hathaway has full ownership, such as See's Candy. One notable example is the Coca-Cola Company, a stock Buffett has held since 1988. This year alone, his investment in Coca-Cola is expected to yield more than $656 million in dividend income. With an initial cost basis of $3.24 per share, Buffett now enjoys a remarkable 50.5% dividend yield on cost, meaning he more than doubles his initial investment every 2 years through dividends alone. Coca-Cola's consistent dividend growth for over 58 years exemplifies the success of Buffett's strategy of investing in companies with strong competitive advantages and holding on to them for the long term. In 2016, Buffett made a substantial investment in Apple, and Berkshire Hathaway now owns over 5.9% of the company. While he has already seen significant returns on this investment, it is poised to be the next Coca-Cola. This year, Buffett is set to earn $822 million in dividends from Apple, making it the most lucrative among his holdings. Although the exact cost basis is not disclosed, given the time of Buffett's investment, it is estimated that his yield on cost is currently around 2 or 2.5%, with Apple being the most valuable brand globally, boasting massive customer loyalty, and exhibiting 9 years of dividend growth with a 10.5% 5-year compound annual growth rate. Buffett's investment is anticipated to mirror the success of Coca-Cola in the long run. Buffett's long-term investment approach extends to other dividend stocks in his portfolio. For instance, Moody's, the credit rating, risk assessment, and data analytics company, contributes over $55 million in annual dividend income to Berkshire Hathaway. With an initial cost basis of $10.05 per share, Berkshire's annual yield on cost is an impressive 22.3%, allowing Buffett to double his initial investment through dividends every 4.5 years. American Express is another notable dividend stock in Buffett's portfolio, providing $260 million in annual dividend income. The examples of Coca-Cola, Apple, Moody's, and American Express underscore how Buffett's commitment to long-term investing can result in substantial yield on cost, demonstrating the effectiveness of his investment philosophy over time. At an initial cost basis of $8.49 per share, Berkshire Hathaway enjoys a substantial 20.3% dividend yield on cost, signifying that they can potentially double their initial investment through dividends alone in just under 5 years. Among other notable investments in Warren Buffett's portfolio, Bank of America pays $743.7 million in annual dividends, Wells Fargo pays $659.3 million, Kraft Heinz pays $521 million, US Bank Corp pays $222.5 million, and JP Morgan Chase pays $214.2 million. These examples highlight the variety of dividend stocks that contribute to Berkshire Hathaway's significant dividend income. The key takeaway is that investing in companies with sustainable competitive advantages over an extended time horizon can result in substantial yields on cost and significant returns. This video provides intriguing insights, and if you find this topic interesting, feel free to share your thoughts in the comments. Additionally, more stock review videos will be coming soon. Thank you for watching, and if you enjoyed the content, consider leaving a like, subscribing to the channel. Your comments are appreciated, and thank you for your continued support.